Gold, whether it's being managed at this moment or not, is immaterial. It's signaling what it should, and that is economic problems ahead. Remember, gold acts like a barometer, not a thermometer. It's signaling to us now things have gotten so bad that I'm getting into new high territory.
Gold and silver cannot bankrupt, and everything else in the system, including the Federal Reserve, the U.S. Treasury, all central banks across the globe, any and all can default.
Central bankers set the rates. At the extreme moments, the market sets the rates. It doesn't matter what the central banker says. The market will say, we don't trust debt anymore. And at that period, the super juice, the turbo juice, as I say, will actually be focused on gold. And that's when gold goes unavailable.
Gold surged past the crucial $2,000 per ounce mark in November, reaching a new all-time high of $2,135 per ounce on December 4th, before retracting to its current levels, hovering around $2,030 per ounce in early December. This surge in gold is bolstered by expectations of potential rate cuts by the Fed, with markets indicating a likelihood of over a 50% chance of a rate cut in March 2024. Renowned analyst David Morgan perceives gold's recent ascent as a crucial signal of impending challenges. He emphasizes gold's substantial position as the preferred asset for central banks in China and Russia during severe crises. While silver lacks the same monetary fallback recognition among bankers, David highlights gold as a vital economic signal, expressing uncertainty about its upper limits and suggesting potential figures of $2,500 or even $3,000 for the upcoming year, especially in the face of concurrent unforeseen crises akin to black swan events. Gold holds intrinsic value without counterparty risk as a safe haven, often serving as a hedge against market volatility and economic downturns. Bill Holter delves into the historical significance of gold and silver as cash equivalents, especially during market downturns. Historically, they have been sought after as safe havens during financial crises. Bill foresees individual defaults and significant defaults among systemic players, referencing a concept he terms the Great Taking. Even major institutions like banks, brokers, insurance companies, and exchanges could collapse, potentially leaving individuals with nothing. Both Bill and prominent analyst Francis Hunt stress the importance of self-protection through ownership of gold and silver during challenging situations. They highlight the accumulation of vast assets by certain entities, implying a future where individuals may possess minimal to no assets, forming a corporate fascism that substitutes for statism and a form of communism for the masses. These strategies could result in individuals losing their assets, emphasizing the potential compulsion to sell at a low point due to financial constraints, even if one anticipates an asset's rise. We will present clips from famous experts' interviews with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
But gold is actually breaking out, as you said, Elijah, and I think this is portending what lies ahead. You got to remember, from my perspective, and maybe the other two, gold is more establishment than we realize. I mean, central banks collect gold, China collects gold, Russia collects gold. The bankers know that gold is the money of last resort. If everything falls apart, they could go back to a gold standard or partial gold standard. Silver doesn't see that luxury. Silver is not a monetary metal as far as the bankers are concerned. So gold, whether it's being managed at this moment or not, is immaterial. It's signaling what it should, and that is economic problems ahead. Remember, gold acts like a barometer, not a thermometer. It's signaling to us now things have gotten so bad that I'm getting into new high territory, and no one, not Bill, not Francis, not me, knows how high is high. So we could see, 2,500 next year, maybe 3,000. We see 2 or 3 black swans hit. You see an understanding bank go down. At the same time, there's a cyber attack on the financial system, along with Europe saying they didn't get enough heat. And you've got a real problem. And all those things are realistic. Again, I know I sound like Mr. Doom, but look, I've studied this my whole life. And I have never been in the position where I am right now, which is I am on edge. I am not feeling happy. I'm not feeling good. And money isn't really a solution. It can be in a short term. It can help. But it's a physical economy that we need to do well for everybody. And that's breaking down. That's the problem.
Gold and silver used to be cash. And the place to be when there was going to be a bear market, a market downturn, was cash. and that was gold and silver. The idea today, if you put your money in cash, it's got to be in a bank, it's got to be in a brokerage account, it's got to be in a money market. You have counterparty risk, and the paper itself, you're going to see massive defaults, but you're also going to see defaults of the systemic players. I mean, I don't know whether you have read or agree with the Great Taking. I think it's pretty spot on. And I think they're going to tank banks, brokers, insurance companies, even exchanges. That's the plan. And people are going to end up with nothing. My suggestion, and I've said this for 4 or 5 years now, when people ask me how much should I put into gold and silver, my standard answer now is whatever you don't want to lose. And the reason I say that is because gold and silver cannot bankrupt, and everything else in the system, including the Federal Reserve, the U.S. Treasury, all central banks across the globe, any and all can default.
The one thing that many people ask is, it's what do you functionally do and how do you transact practically in a major disinflationary spell where often even gold and silver's official price, let's just leave that there for now, will dip because everybody will be panicking to make a rent check or to purchase food. That's where having the cash that Bill mentioned will play a role, but it's more purely for a little bit of oil for the transition period. And I would use it to purchase further metals, actually, but you also may be in a situation where you'll have absolute necessities that you'll need. And even in that environment, people still need to eat. You've got to cover costs. You've got to be secure, et cetera, et cetera. So, you know, ammunition for security and bullets, it gets very resetty, I know, but I wouldn't look that one in the face. If you've got gold, silver, and you can protect yourself, you're a long way to getting through a pretty sticky situation. The reference of the coordination that Bill also made reference to, and as again we share similar opinions on this, is isn't it convenient that everything's been synchronized potentially, and that this great collapse, and you were actually, I think it was Dunnigan was referring to how this always seems to happen. They mop up the small rats and mice, and the big corporate fascists pick up all the market share, the chosen ones that are designed to survive. And in an environment like that, mom and pop businesses will go. So, you know, it's not even your business that will protect you. You need to get it. It's like being taken back to sticks and stones and barbaric. You've got to protect yourself, protect your domain. Ideally also, I think there's another trick that has the equivalent of the Great Taking in it, and that's the people are underestimating the likelihood of an interest rate spike driven by a major debt-based event. And that's a very convenient tool to add to the kind of tool that Bill and Dunnigan were referring to shake people out of their homes. We also know that there's entities that are doing a massive accumulation of assets, and you will own nothing, and a rentier society. This whole corporate fascism, which are actually proxies for statism, and then a kind of communism for the masses. You've got to avoid being shaken out of your assets. The problem sometimes is you can know something's going to go up and you hold on, but if you can't afford to hold on, you get flushed out at the bottom on things, and that goes for your home. If the mortgage payment can spike for a while, they can keep it up for long enough that you can't afford. Everybody gets repoed, and you end up with a rental agreement and BlackRock as your landlord. Don't underestimate that attack vector as well as those on your equities.
The U.S. has experienced changes linked to the Federal Reserve's consistent federal funds rate of 5.25 to 5.5%. This coincided with a drop in annual consumer price inflation from 5% to 3.1%, resulting in a rise in the real interest rate from nearly 0 to about 2% in 9 months. Bill highlights the impact of inflation and higher rates on homeowners and buyers, noting the U.S.'s low ownership of gold and silver, around 1 to 2%, indicating a need for more awareness. Simultaneously, the total U.S. federal government debt surged from $30 trillion in February 2022 to $33.1 trillion by December 2023, $26.5 trillion held publicly, and $12.1 trillion in intragovernmental debt. Reflecting on 7 years of abundance without significant savings, Francis emphasizes how past debts now constrain borrowing during lean times. Moreover, Americans owe a massive $1.08 trillion on credit cards, leading to a surge in credit card rates above 20% due to the Federal Reserve's 11 rate hikes. David anticipates this trend might bring record-breaking challenges in delinquency, credit card debt, foreclosures, and more for countless households. Let's get back to the interview.
People experience difficulty personally. Once they experience the personal difficulty, then they start looking for the reasons why, and obviously inflation's a big reason. And I think it's a far larger number than you might suspect of people that are definitely feeling the pinch. I'm going to say probably 80-85%. I mean, unless you're in the top 5 or 10% of wage earners, inflation bites. Does it bite the top 5%? Yes, somewhat, but not drastically. So it's really a huge majority is feeling the bite of inflation. And I would add to that, they're also feeling the bite of higher interest rates because, I mean, look at anybody who owns a home. If they want to move, will they move knowing that whatever loan they get, if they have to get a loan, is going to be much higher? That's the first part of it. Then the second part of it is buyers. I mean, they've had their knees cut off from under them. What an income that would have supported $1 million in borrowings 2 years ago now only supports $500,000-$600,000. So it's a double whammy. I think people are definitely feeling it, and it is a wake-up call. Now, does the average person know what to do about it? Probably not. I mean, what's the ownership of gold and silver in the United States? 1% or less? Even if it's 2%, that's not a real awakening.
He's absolutely right, Bill, in terms of saying recessions. I also don't think we do ordinary recessions. I would say, most things are pretty depressional. I think the consumer is very badly hit, and they're also understating through the stats, the BLS, the victory over inflation. You've also got to remember these inflation numbers are on being compared 1 year ago to quite high water marks when you're at double-digit inflation. So being a further 2.5% up on a number that a year ago was 11% or 9% is not great progress. It just means you're still gaining speed in inflation. It's just not quite at the same rate of acceleration. We've had 7 years of feast, actually, and we didn't put anything away in the biblical sense in the silos. And now we're properly hitting the buffers on the debt. The debt can't be extended. The credit card can't be extended. We run up the bills on the credit cards while we were feasting and there was abundance. Now we have 7 years of famine. We even borrowed, in terms of the states, offshore from other people to get food while we were feasting. Now we're having the famine and the silos are empty, and we owe the food back to the other nations that we borrowed. So there's no way out as far as I can see. And for people, silver and gold has to be a far larger part, as again, Bill was referencing, and I'm sure Dave will say similar, of portfolios than it currently is.
U.S. credit card debt is at a record high. According to the Federal Reserve of New York, it's hit a new high of $1.1 trillion during the third quarter of 2023. That increase is the largest since the Fed started tracking data. The report shows that the rate of delinquency is the highest since 2011. The savings rate is near an all-time low. During the pandemic, savings shot up to 34%. Now it's 1/8 of that. Foreclosures have surged. There were filings of over 95,000 foreclosures in the first quarter of 2023, which is 22% higher than the previous year. So I see 2024 with the trend continuing, and I think you're going to see new records in delinquency, credit card debt, mortgage problems, and car repossession.
In 2023, gold performed remarkably well despite high interest rates, surpassing other assets like commodities, bonds, and most stock markets. The uncertainty around the Fed guiding the U.S. economy safely, with rates above 5%, and the looming possibility of a global recession suggests the importance of investors holding effective hedges like gold in their portfolios. What are your predictions regarding the future price of gold, considering its impressive resilience amidst uncertain economic conditions? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.